Okay, let's jump right into this explainer. If you've been following along, you know we've already laid down a lot of rules and checklists. But honestly, a process is only as strong as your ability to actually measure it. So today, we're transitioning from those compliance checklists into building a dynamic, diagnostic measurement layer for the entire payroll and contractor cycle. We are turning theory into a living, breathing framework.
To pull this off, we've got a pretty straightforward roadmap. We're going to cover the measurement layer, diagnose those high and medium impact risk exposures, track our 15 key performance indicators, learn how to read all that data together, and then set the stage for the advisory toolkit. Let's get to it. Section 1, the measurement layer. Let's start by connecting what we're doing today directly to our last lesson on internal controls.
So, back in Section 07, internal controls were all about the what to do. Think of those controls as preventative medicine designed to stop issues before they start. But the risk register and KPIs we're covering today, that's your active diagnostic dashboard. The risk register shows you exactly where your most serious exposures are hiding and what's causing them. Then the KPIs give you the ongoing, real-time data you need to prove those controls are actually working, long before an auditor ever knocks on your door. Section 2. Diagnosing high-impact risks. Now we're getting into the heavy hitters, the 11 high-rated risks where the money literally just leaks out of a business. And listen, every single one of these has to be assessed for your clients before the next payroll run or contractor payment. You don't wait for year-end, you don't wait for an audit, and you definitely don't wait for an IRS notice. We'll kick things off with contractor classification risks. First up is worker misclassification. Assigning contractor status just because it's cheaper or easier? Yeah. That triggers devastating impacts like back FICA for both shares, FUTA, SUI, and massive class action risk. Then there's offering contractor benefits. Giving a contractor a health stipend might seem nice, but it is literally the strongest indicator of an accidental employment relationship. Next, paying a contractor without collecting a W-9 first leaves the company on the hook for a 24% backup withholding liability. And finally, violating strict state rules like California's AB5 ABC test hands the worker full employee rights and triggers brutal PAGA penalties. Now, I want to talk about a very specific number, $630. That is the uncapped per-form penalty for the intentional disregard of filing a 1099 NEC. A standard late form might sting a bit, but if the IRS slaps you with intentional disregard, the financial hit is absolutely staggering. And here's why that matters so much. A lot of people think intentional disregard means you actively tried to commit fraud. Not true. Usually the root cause here is simply failing to maintain a year-to-date contractor payment tracking system. So saying, "Oh, we didn't know we had to file," sounds like a totally innocent oversight, right? Well, it is a completely useless defense if you collected the W-9 but never bothered to maintain the tracker. Ignorance does not protect you here. Moving on to the direct payroll and cash bleeds. Think about the ghost employee. This is a direct, ongoing cash loss that can run undetected for years if you don't have proper segregation of duties. Then you have late payroll tax deposits. Sure, that triggers 2 to 15% penalties, but the real nightmare is the trust fund recovery penalty, which can make responsible officers personally liable for the withheld taxes. It's serious stuff. And lastly, processing contractor payments through the payroll system. This just creates unnecessary FICA complexities and guarantees an incorrect W-2 at year-end. The last batch of high-impact risks sits over in HR and benefits. Late 401k remittance is a huge one. It triggers an immediate Department of Labor prohibited transaction, and get this, there is absolutely zero grace period, none. Then there's final paycheck noncompliance. Missing a state deadline for final pay can trigger waiting time penalties of up to 30 days' wages per employee. Finally, missing a COBRA notice, usually because a simple trigger checklist was forgotten. To put that COBRA risk into perspective, a single missed notice accumulates a penalty of $110 per day per beneficiary. That's a penalty that just quietly racks up in the background for months and months before anybody even realizes a mistake was made. Section 3. Medium Impact Risk Exposures. Let's step down just slightly in severity and look at the operational friction points. These medium risks might not bankrupt the company overnight, but man, they cause massive internal headaches. A TIN mismatch on a 1099 NEC leads straight to an IRS CP 2100 notice and backup withholding nightmares.
FLSA misclassification, treating a non-exempt hourly worker as exempt, triggers hidden back overtime liabilities. And PTO liability understatement, if you aren't recording that properly, you're creating massive balance sheet errors and setting the stage for very messy separation disputes down the line.
Section 4. Tracking the 15 KPIs. So, the big question, how do we actively monitor all these risks? Well, we use our 15 key performance indicators.
The first half of our dashboard tracks the absolute vitals for employees and payroll. Look at the frequency here. These are monitored heavily on a per-run or per-event basis because you need immediate feedback. We're looking at the payroll accuracy rate to ensure people are paid correctly the first time. We track the on-time payroll rate. We monitor headcount variance, comparing the active count in the payroll system against HR's active count. We're also checking tax deposit compliance per deposit, 401k remittance per run, and final paycheck compliance for every single separation.
The second half of the KPIs starts with COBRA notice compliance per event, and then we pivot over to the contractor and advisory metrics. These are measured a bit differently, annually, quarterly, or monthly. We track the classification review rate, which is the percentage of your contractors actually reviewed in the last 12 months. We check 1099 NEC accuracy annually, statement of work budget utilization monthly, the overall contractor to employee cost ratio quarterly, and the PTO liability trend on a monthly basis.
Section 5. Reading the data together. Now, having these metrics is great, but looking at a single number in isolation doesn't really tell you the whole story. You have to synthesize the vitals.
For instance, what if you see a 100% perfect payroll accuracy rate, but it's sitting right next to a deteriorating headcount variance between payroll and HR? Well, you aren't looking at a payroll success story there. You are looking at a severe data integrity problem. Sure, the system is paying the entered names perfectly, but the system doesn't match reality.
Or, consider this scenario. As an advisor, what if you spot a rising contractor to employee cost ratio, coupled with a 0% contractor classification review rate? That specific combination is a giant red flashing light. It screams unchecked misclassification exposure. You're spending more and more money on contractors, but nobody has reviewed a single one against IRS tests. That tells you an audit disaster is brewing long before the IRS even gets involved.
Section 6. Next, the advisory toolkit. All right, we have the rules, we have the controls, and now we have this amazing diagnostic dashboard. So, where do we go from here?
Well, in Section 09, which is our course capstone, we're going to take absolutely everything we've built so far and show you exactly how to apply it in the real world. We'll dive into a 5-step client diagnostic, show you how to spot those subtle red flags, and walk through real-world case scenarios that highlight exactly what good advisory looks like when things go wrong.
But before we get to the toolkit, I want you to take a hard look at your own dashboard. Ask yourself honestly, do your clients' KPIs genuinely prove that their controls are working? Or are their vitals quietly warning you of a massive, expensive audit just waiting to happen? Think about it. We'll see you in the next explainer.